But yes, there's been some very understandable skepticism around US gold market revaluation. That because we had the same kind of skepticism when people were doubting that the Bank of International Settlements would revalue gold as a first-tier high-quality liquid asset. So I'm going to update and run through the gold revaluation footprints we're now evidencing, along with the most likely dollar gold price expectations. Now, I'll also provide some end-of-year realistic silver targets. Now, bearing in mind, the bulk of our information gets distilled through the largest liquidity providers, physical liquidity providers, who see both gold and silver grossly undervalued versus gold and silver that broke out months ago into all-time highs. So let's start with gold. Just as the Bank of International Settlements inflection point, where they revalued gold as a first-tier high-quality liquid asset, drove a race by global central banks to swap fiat currency assets for physical gold, just 33 months later, gold price in dollars is currently $2,000 per ounce higher. So net out the intra-month legacy market volatility, and gold has averaged out a very quiet, stealthy, relentless $60 per ounce rise in price. This relentless gold demand has driven the legacy paper market to an impossible to maintain divergent inflection point that can only be resolved by a massive bid-only margin call or a US Treasury gold price revaluation. So now that global physical exchanges have become sufficiently liquid to benchmark a real supply demand gold bullion price outside the CME LBMA ring fence, the stealthy gold revaluation process that commenced directly after the Bank of International Settlements revalued gold as a first-tier high-quality liquid asset on the 1st of January 2023 has gathered sufficient momentum to force the US Treasury gold to be revalued. And we'll kind of look at those footprints. And as we've been drawing attention to, every single non-dollar denominated fiat gold price has been driven into all-time highs. But as we've been focusing on, the real game changer is that China took the gloves off the moment the yuan gold price became fully Basel III compliant. Now, the fact that this is still unnoticed by the mainstream media, these are the analysts who try and form fit news releases, interest rate drivers, these kind of things which influence the paper market actors greatly, but they completely miss the underlying race by central banks to swap dollars and associated fiat currencies, this whole range of fiat currencies, for physical gold. But here's the key: at any price. They don't care if it's higher or lower, they are accumulating. And with the Basel III compliant yuan-backed gold price being benchmarked through a growing network of physically backed SGE exchanges, Western-facing, Beijing is stealthily assuming the gold convertibility mantle. The ease of hedging the yuan price against all other FX currencies, bonds, etc. And so the PBOC is rapidly usurping the dollar as the global hegemon, ultimately forcing Basel III compliance on the last holdout, non-Basel III global central bank, forcing an imminent gold price revaluation. Now, little noticed by the mainstream media is that enabling the PBOC to directly benchmark physical gold against US Treasuries, it unlocks vaulted bullion to be used as financing collateral within the entire BRICS system and facing the West. Now, gold is pouring into these Western-facing gold vaults, and simply, so how it works is this gold simply swaps hands completely outside the legacy system in the vaults underpinned by Basel III compliant yuan-gold. The gold doesn't leave the vaults. Hence, there is no dilution when it moves around, no volatility when it moves around. And as we summed up in our last episode, with the SGE gold price also seamlessly interchangeable with Western central banks' underpriced legacy COMEX exchange gold, that gold has been drained, incentivizing every single global central bank to race to swap more fast depreciation dollars to buy the same ounces of gold. Now, the White House understands US Treasury gold is once more under attack by foreign central banks, much like it became under attack when Nixon in 1971, when Nixon took the convertibility of gold versus the dollar. This is tectonic, and so really the only tool that's left in the Fed's gold price suppression bag of tricks has been completely usurped. If those prices do not begin to reflect a real physical supply-demand price, every single ounce is going to get drained. It's no coincidence that Treasury Secretary Bessent is currently demanding a full Fed audit, which includes the 8,133 tons of Treasury gold being stick-handled by the Fed. Now, we talked about it a long time ago. It's gone off. It seems to have disappeared under the radar, what was going on. It's on the front burner. Even Bloomberg was talking about that this morning. So it is on the front burner. This would be the first full audit, trusted audit, that would fully inspect all of the vaults, but it was also uncover the extent of double ownership claims on US Treasury gold. Bearing in mind, a lot of it was lent out. Now, this has to be concluded before the US gold GRA account, the gold revaluation account, can be marked from $42 or 8 billion, which is current prices, now verging on at real market value at $1 trillion. So 8 billion to $1 trillion in a click of the mouse. Now, obviously, this revaluation process itself would drive gold significantly higher than current prices. And that would provide a healthy buffer when it's revalued. Now, if the White House does not move to revalue soon, there won't be enough bullion to meet delivery obligations, which risks triggering a force majeure condition, in turn driving global prices into a bid-only condition, forcing the Fed to become a price taker at much, much higher prices. Now, they can print their way out of it, but it's going to drive the price higher. And as we previously assessed, at best expectation, the optimum time to revalue gold would be directly after the COMEX December futures contract runs off the board at first notice day. Now, first notice requires all long or short derivative bets to either pay up or stand to deliver on the 28th of November. Now, while this could contractually allow deliveries to be effected by the last day of December, because it is a December contract, the revaluation event would force every single ounce outstanding to be physically delivered ahead of the 1st of January 2026. Now, given the current structure, this would in itself require buying a lot of gold at market in the interim, especially as really the mainstream media pundits have, for the last $1,000, for the last $1,000 move, they've been warning gold was overbought already $1,000 ago. But what they're not getting is that the COMEX has become the price taker, not a price setter. So let's delve into the charts for a sec. Now, very short term, and I just want to say we're recording this ahead of FOMC. This is Wednesday, the 17th, and it's about an hour and a half before FOMC. And essentially, as you say, we always expect speculator froth to be rinsed out from time to time. And we see it, but it's very shallow. And it's driven by algo-driven conditions into events like, as I say, FOMC today. But this is constructive, as it quickly finds levels where central banks and sovereigns anticipate these specs to actually be rinsed out. Spoiler alert, as we will see, these paper-driven dips are very, very shallow, resulting in a series of higher, physically supported stair steps to rally from. Now let's take a look at current conditions and how that provides clues of upcoming prices. Now, bearing in mind that this is the COMEX or the futures chart, and this is the overbought, so-called overbought conditions. Now, as I say, the legacy actors operating in so-called overbought market conditions have been unable to rig historical wash and rinse cycles, and they've been forced to become price takers step by step by step, and even more so now. And why? Because they're being caught. There's a bunch of margin calls coming in, i.e. the brokers are saying, give us enough money to support your short positions. Now, given every single global central bank followed the BIS in hedging their national fiat currencies and related bond holdings with physical gold. That's what's going on. And it left the only non-Basel III compliant Fed, the only central bank still short of gold. However, the imbalance is about to be rectified, and the only way to do this is to revalue US Treasury gold reserves from $42 to market. Now, given there's an empirical evidence that US Treasury gold is to some unknown degree rehypothecated, which is a view widely held by very well-respected institutionals, and that follows the embarrassing, glaring delivery delays and vault audit refusals that were given to the Bundesbank. So as a result, foreign central banks are actively repatriating their gold holdings from the interconnected US Loco-London synthetically diluted legacy vaulting systems. They're not trusted. Goodness me, if you went to your vault and you asked to have your bullion back, you'd be there with your arm out and they'd be telling you, oh, you can't have it. It's just, and you can't even see it. I mean, what would you do? You would ask for it all. I remember Harvey Organ years ago going to Scotiabank and basically asking to see his gold, his vaulted silver, and ended up, they wouldn't show it to him, and it ended up he had to call the RCMP. It was in Canada, and the RC, and once they went in there, they found it was gone. It was somewhere in Asia. These numbered bars were somewhere in Asia, so it clearly been lent out. So obviously there's there's no trust in this system. So what this does, really, where we are, is there are two primary questions, which are how much unbacked, unallocated physical gold has yet to be bought back at market into competing central bank demand. And the other question is, given this at market demand is in itself going to drive the offer to sell a bullion, immediately deliverable bullion, that is, T+1 deliverable bullion, significantly higher, at best estimate, what is that aggregated price? So that's what we're going to do here. And it's a constantly changing picture. And that's why we want to keep you up to speed as to what all our liquidity providers are seeing and how to best distill that. Now, obviously, given the true global supply-demand data was deliberately concealed after the COMEX gold market was launched in 1994, enabling the remaining 8,133 tons of Treasury gold to be secretly leased, sold into the market without a forensic audit, we just simply don't know the residual degree of rehypothecation, double ownership. So some clues are there, though. In February 2023, the Fed refused to allow the German Bundesbank to inspect their holdings of the New York Fed vaults. Now, this led to the Bundesbank request to immediately repatriate the first 300 tons of their 1,350 tons deposited after World War II. I mean, a lot of it was in the 50s and 60s, but after World War II. And these were numbered bars. However, instead of, when requested, instead of saying, oh, okay, we'll fly these 300 tons out, it's a technically deliverable T+0, really it's in the vault, it should be in the vault, you should be able to just hand it over, or get it securely moved from a Brinks or Loomis truck into the airport. So really what you should be is 12 days, which is normal. We see this kind of silver being shipped around in 25-ton lots. So really 12 flights, 25 tons, should have done it. Yet they was talking about a 7-year T plus 2,555 day delivery process. This is ludicrous. It's beyond credible, but the records are there. That's exactly what they actually wanted to do. Now, this spilled the beans on just how short of gold the CME LBMA cartel were. They were caught out. Now, this first central bank delivery default, this was a delivery default. It raised a major red flag that the entirety of the published or unaudited US Treasury gold holdings were likely double counted or rehypothecated to some degree. And while an embarrassed Fed scrambled to cut the timeline to repatriate German gold, when it did arrive in Germany, these bars were discovered not to be the same bars as originally deposited. In fact, the mix of bars included newly minted bars mixed with some 1930s 22-carat melt gold, further proving the original Bundesbank bars had been sold and were being repaid in the form of a shell game shuffle.